It is currently Sunday, November 30th, 2025. The markets are closed. We are looking at a closing price from the last session for Opendoor Technologies Inc., ticker symbol OPEN, which sits at exactly 7.70 US dollars. In the final trading session on Friday, the stock saw a slight retracement, moving down by $0.080 or 1.03% intraday. While a 1% drop might seem negligible to the uninitiated, the context here is absolutely explosive considering where this equity was just 5 months ago. We are talking about a stock that was effectively left for dead, trading near 50 cents, now commanding a price tag nearly 15 times higher. The volatility here isn't just noise, it is a signal. Most investors looking at this chart see a classic meme stock revival. They see the retail fervor, the chatter on forums, and they assume this is another hollow rally destined to collapse under its own weight. That is the expectation, that Opendoor is simply riding a wave of irrational exuberance fueled by lower interest rates and a short squeeze. But the reality is far more calculated, and quite frankly, more interesting. The reality is that Opendoor has fundamentally shifted its corporate DNA in the last 90 days, transitioning from a capital-heavy home flipper to a software-first liquidity engine. The market is pricing in a short squeeze, yes, but the smart money is pricing in a total restructuring of the American residential real estate transaction. If you are only looking at the interest rate cuts, you are missing the actual story. When you look at the recent price action, specifically the surge leading up to this 7.70 level, you have to talk about the warrant dividend. This is a mechanism that very few retail investors understand, but it is critical to why we are seeing this price stability. On November 21, just over a week ago, Opendoor distributed tradable warrants to shareholders. This wasn't a cash dividend. It was a strategic weaponization of their equity structure to align long-term holders and punish short sellers. By issuing these warrants, management effectively created a complex derivative layer that forces short sellers to cover not just the stock, but the potential future upside of the stock. It is a brilliant, aggressive move that we rarely see in the tech sector, and it signals that the new leadership, specifically CEO Kaz Nejatian, is not playing defense anymore. He is playing offense. Let's pause on that for a second, because it changes the thesis. The general belief, the common ground most analysts stand on, is that Opendoor is at the mercy of the Federal Reserve. The narrative goes, if rates drop, Opendoor survives. If rates stay high, Opendoor dies. And while it is true that the cost of capital matters, this view is too simplistic. It ignores the massive pivot the company has executed toward Opendoor exclusives and its partnership model. They are moving away from using their own balance sheet to buy every single home and are instead using their algorithm to price homes for other buyers, taking a fee for the technology rather than the risk of the asset. This is the shopification of real estate. They are building the rails, not just buying the trains. We need to dissect the trading behavior we saw on Friday and throughout last week to really understand who is buying this. If you look at the order flow, you see a massive divergence. On one side, you have the retail crowd, the folks using the Robinhood app and SoFi Invest, who are piling in because the stock has momentum. They see the 1,300% gain from the lows and they want in. On the other hand, you have the institutional desks. We are seeing activity that looks like hedging from users of interactive broker trading platforms, likely sophisticated funds trying to manage the risk of those new warrants. But then you have the quiet accumulation. Reports suggest that major custodians and ETF providers, the kinds of massive pools of capital you see at Fidelity Investments or flowing into Fidelity mutual funds, are beginning to re-rate this company. They aren't buying it as a distressed asset anymore. They are buying it as a technology recovery play. If you are only looking at the interest rate cuts, you are missing the actual story. It's important to share if you're holding this many shares of Opendoor during the distribution of the warrants last week. Do you intend to keep those warrants, or did you sell them immediately? Now let's talk about the specific movement we saw closing out the week. That 1.03% drop to 7.70 USD is technically a consolidation. After a run-up of this magnitude, the stock needs to breathe. We saw volume taper off slightly on Friday, which is healthy. If the stock had continued to rocket upward on low volume, I would be worried about a blow-off top, where the price collapses vertically. Instead, we are seeing a shelf build in the $7 range. This creates a support level. Traders using Schwab Intelligent Portfolios or similar automated allocation strategies often look for these periods of low volatility to rebalance positions. The fact that Opendoor is holding the $7 handle despite the broader market uncertainty regarding the pace of future rate cuts in 2026 is a testament to the strength of the current bid. The disconnect between the price and the underlying financials is still the main source of tension. In the third quarter of 2025, Opendoor reported revenue of roughly $915 million. That is a stark drop from the multi-billion-dollar quarters of 2021 and 2022. But here's the contrarian take. Revenue decline is actually good news right now. Why? Because it means they're rejecting bad deals. In the past, Opendoor would buy almost anything to show growth. Now, under the new management regime, they are prioritizing margin over volume. They are shrinking the top line to save the bottom line. The market is rewarding them for discipline. The skeptics see shrinking revenue and scream, "Growth is dead." The optimists see shrinking revenue and say, "Profitability is coming." The price action at 7.70 suggests the market is starting to believe the optimists. We also have to discuss the role of the retail investor versus the algorithm. In 2021, Opendoor was a favorite of the individual brokerage account holder. It was a story stock. Then it became a disaster. Now it is becoming a battleground. You have high short interest, people betting the stock will fall, colliding with a shareholder base that is incredibly energized by the new CEO's aggressive tactics. This creates a powder keg. When you use investing sites to track short interest, you see that Opendoor still has a significant portion of its float sold short. If the stock stays above 7.50, those shorts are paying steep fees to keep their positions open. This is what we call a pain trade. The higher it goes, the more pain the shorts feel, and the more likely they are to buy the stock back to close their position, which drives the price even higher. Let's shift gears to the macroeconomic picture, because you cannot talk about Opendoor without talking about the housing market. The U.S. housing market in late 2025 is weird. We have seen the Fed cut rates, but mortgage rates haven't fallen as fast as people hoped. They're sticky. This lock-in effect, where people don't want to sell their homes because they have a 3% mortgage from 2020, has choked off supply. Historically, low supply kills Opendoor because they need volume. However, the new exclusives marketplace allows them to tap into off-market inventory. They are going to home builders and saying, "Let us sell your inventory on our platform." They are going to agents and saying, "Use our tools to price your homes." This diversification is critical. It means that even if existing home sales remain at 1995 levels, Opendoor can still generate cash. We should also consider how this fits into your broader portfolio. If you are using Fidelity Wealth Management Services or managing your own Fidelity IRAs, Opendoor represents a high beta component. It is not a safe, steady dividend payer, it is a volatility instrument. It moves 3 or 4 times as fast as the S&P 500. For a young investor using the Robinhood app, this is exciting. But for a retiree depending on Fidelity ETFs for income, this is terrifying. But that terror is where the opportunity lives. The market hates uncertainty, and Opendoor is pure uncertainty. But as that uncertainty resolves, as they prove they can be profitable at lower volumes,